Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone. We have been tracking a really fascinating, almost contradictory dynamic in the global markets lately.
Yeah.
Based on reports we've seen across Bloomberg, CNBC, and Reuters. So our mission today is a deep dive into three, I think, really interconnected themes. First, the sustainability maybe of this soaring AI boom. Second, the extreme policy volatility hitting both the U.S. and Europe. And third, this stunning, absolutely record-breaking rush into gold that's happening at the same time.
Yeah, it's quite the contrast, isn't it? It's like aggressive optimism is slamming right into, well, genuine survival instinct in the markets. You've got companies, making these huge long-term bets on AI. CNBC and others are covering how this suggests like a limitless future. SoftBank, for example, is talking about artificial superintelligence, ASI. That's AI potentially 10,000 times smarter than humans. Huge ambition.
10,000 times smarter.
Right.
Wow.
Right. But then, literally in the same news cycle, you see investors just fleeing towards the ultimate safe haven, gold, which signals this really profound anxiety about, well, basic things like global fiscal health and geopolitical stability.
Exactly. So what we really want to unpack for you today is what's fueling this split? How can we have this almost euphoria over transformative tech while at the same time seeing this historic level of fear about government stability and just basic trade? Let's maybe start where the money is flowing fastest, the global AI race.
Okay, so let's unpack the sheer, aggression we're seeing on the AI frontier, specifically this rapid global expansion and, crucially, the underlying profitability questions that are starting to surface. Anthropic, for one, the Amazon-backed firm, they're making a major global push. Plans to open their first office in India in Bengaluru early 2026. That's their second in Asia after Tokyo. And this expansion, which CNBC detailed, it isn't just about planting a flag. It's clearly strategic. Their CEO, Dario Amodei, he's actually visiting India this week, meeting officials. He's quoted calling India compelling. Why? Well, the technical talent pool, obviously, but also government commitment to, ensuring AI benefits everyone. They're specifically targeting what they call social impact. Uses, think, education, healthcare.
But calling it a land rush might be, well, an understatement. This move also shows they're playing catch-up, doesn't it? I mean, Anthropic says India is second only to the U.S. for using their model, Claude. But the actual download numbers, based on that App Figures data that was reported, they tell a different story, maybe? About the scale of competition?
Yeah, the scale is immense. Claude reportedly had about 118,000 downloads in India back in August, which sounds okay until you compare it. ChatGPT had a staggering 10.3 million, Perplexity 6.4 million. So yes, Anthropic's in the game, the potential is huge, but market dominance, that's still very much up for grabs.
And that race for dominance is driving just unheard of spending. Which brings us inevitably to NVIDIA. They've basically become the central bank of this whole AI boom. Reports noted they struck their first direct partnership with OpenAI, bypassing the usual cloud rental model.
Right, a direct deal. And that partnership, according to Bloomberg, it could involve up to $100 billion just to build the data center capacity needed.
$100 billion.
It's massive. And the infrastructure demands are incredible. We're talking 10 gigawatts of power.
10 gigawatts. Just for context, what does that even mean?
Well, think about 4 or 5 modern nuclear power plants. That's the kind of output needed. Jensen Huang apparently framed it as deploying maybe 4 to 5 million GPUs. And investing at that scale, it needs some seriously creative financing, which brings us to xAI.
Ah, yes, Elon Musk's venture.
Indeed. xAI is reportedly raising $20 billion. That includes up to $2 billion in equity from NVIDIA. But what's really novel here, and maybe slightly eyebrow-raising, is the structure. Reports detailed how $12.5 billion of that debt is actually backed by the NVIDIA GPUs themselves, hardware as collateral.
So using the chips to finance buying the chips.
Essentially, yeah, it offers this unique potential playbook for these cash-rich tech firms to maybe lessen their debt exposure given these incredible capital demands.
Okay, so that's the massive investment side. But here's where that, initial euphoria starts hitting the reality of the balance sheet, which is this AI profitability question that seemed to rattle markets this week. Oracle shares took a hit, right? After that report questioning the margins on its NVIDIA cloud rental business.
Exactly. And what's fascinating is the disparity. The gross margin for that specific NVIDIA cloud rental arm was reported at just 14%.
14%. Compared to Oracle's overall margin, which is usually, around 70%?
Around 70%, yes. So that kind of margin compression, it immediately raises a pretty fundamental question. If the core business of renting out the hottest hardware on the planet yields such thin margins, well, how sustainable is this whole boom, really?
And how does that square with the official narrative? NVIDIA's CEO, Jensen Huang, he offered a rebuttal, didn't he? In an interview mentioned in those reports.
He did. He suggested, thin margins aren't that unusual when you're first ramping up a totally new technology. He assured investors, quote, over the life of the system, they'll be wonderfully profitable. And he emphasized the complexity, the high costs, land, power, cooling needed for these giant supercomputers.
Okay, so it's a long-term promise, a bet on stability, really.
It requires faith, yes. Which, brings in the bubble debate. Peter Oppenheimer at Goldman Sachs, he dismissed immediate bubble fears, argued it's driven by fundamental growth, strong balance sheets, different from past speculative bubbles, he says.
But others aren't so sure.
Right. We have to acknowledge the counterpoints highlighted elsewhere in the financial press, concerns about extremely high market concentration, just a few names driving everything, and those parabolic moves we saw before, some of the recent pullbacks in U.S. indexes, makes people nervous.
Yeah, and the sheer scale of capital, the long-term profitability needed for these AI projects.
Yeah.
It screams for market and policy stability.
Mm-hmm.
But when we actually look outside the tech bubble, the global backdrop seems to be providing anything but stability.
Let's pivot now to those deep policy friction points that seem to be driving global anxiety.
Okay, we can start in the U.S. The government shutdown is, in its second week now? And the immediate fallout, as Reuters reported, is this kind of devastating dearth of data.
Mm-hmm.
It's effectively tying the Federal Reserve's hands. How can you make policy without basic economic inputs, employment data, inflation metrics? Right. No data, no informed decisions. And that paralysis seems to be fueling a pretty profound split within the Fed itself. You've got policymakers sort of publicly airing very different views now. Governor Stephen Miron, for instance. He's apparently pushing hard for much faster, deeper rate cuts, penciling in 5 more this year.
5 more cuts this year. He's citing things like declining immigration, expected tariff impacts, things he thinks will suppress the deficit.
But then you have Jeff Schmid, the Kansas City Fed president, worrying about the exact opposite.
Exactly. He's worried that if you boost demand too aggressively right now, you could get an outsized increase in prices, inflation risk. And what's particularly concerning from his perspective, he observed that price increases are becoming much more widespread, affecting almost 80% of consumption categories now.
80%? That's broad.
It is. And the market obviously cares deeply about this division. This uncertainty just fundamentally undermines confidence in the Fed's direction.
And that policy instability, it's just as sharp across the Atlantic, isn't it? France looks engulfed in fiscal turmoil, highlighted by that shock resignation of Prime Minister Sébastien Lecornu after, was it 27 days?
Just 27 days. It really underscores this political deadlock that seems to be preventing any meaningful fiscal action.
And that deadlock is dangerous given the numbers. CNBC coverage pointed out France's debt pile. It's sitting at 113% of GDP.
113%. That vastly exceeds the EU's 60% target rule. Goldman Sachs responded almost immediately, raising its 2025 deficit forecast for France to 5.5%. When your political system can't deliver stability to tackle a debt load that size, well, that creates systemic risk for the whole Eurozone.
And piling onto that risk are these growing trade disputes which directly hit the cost of global manufacturing. The EU announced plans to dramatically cut its tariff-free steel quotas by 47% and hike tariffs on anything over that quota from 25% up to 50%, all to protect their own industry.
And the fallout was instant. The UK steel industry warned this is maybe the biggest crisis it's ever faced. Makes sense, since the EU buys about 80% of UK's steel export.
80%? That's huge exposure.
It is. And furthermore, the European Automobile Manufacturers Association, ACEA, they're deeply concerned too. They stated this measure will inevitably push up input prices for car makers, creating broader inflationary pressure across Europe. So there you have it. Global policy directly causing real, tangible cost inflation.
And that cost friction brings us right back to the tech world, specifically the escalating chip war. U.S. lawmakers are apparently now calling for even broader bans on selling chip-making tools to China. This came after reports highlighted that Chinese chip makers legally bought $38 billion worth of sophisticated gear last year.
$38 billion. That's a massive 66% increase from 2022. And the concern, obviously, is that these legal sales are dramatically speeding up China's path to self-sufficiency in making advanced chips.
It's quite the irony, isn't it? You have NVIDIA and OpenAI planning this $100 billion infrastructure build.
which relies entirely on stable supply chains and competitive prices for every physical bit. The steel in the racks, the chips themselves.
Yet the whole geopolitical landscape seems determined to inject volatility, fiscal uncertainty, and these artificial cost hikes through tariffs and export controls.
Yeah. So if we try to connect this all back to the bigger picture, you have the AI euphoria, absolutely, but underneath it, this deep geopolitical and fiscal friction, and all this policy uncertainty, the Washington gridlock, European fiscal worries, escalating trade wars, it seems to be driving one particular asset to a completely new peak. Gold.
Gold.
Right.
Spot gold recently smashed through $4,000 an ounce for the first time ever. It's effectively doubled in value in just 2 years. Bloomberg and CNBC coverage emphasize it's now on pace for its best annual performance since the inflationary 1970s.
Yeah, the 70s.
Yeah.
And the drivers. Pretty textbook safe haven demand, tied directly to all the policy uncertainty we've just been mapping out. The U.S. shutdown, geopolitical jitters, U.S. fiscal stability concerns, and of course, expectations of more Fed rate cuts, which tend to weaken the dollar and boost gold.
But there's a structural shift happening too, isn't there, with central banks?
Oh, absolutely. Central banks have become really critical drivers here. They flipped to being net buyers way back after the 2008 financial crisis. But they dramatically doubled their pace of buying gold after the U.S. froze Russia's foreign exchange reserves back in 2022. That single event seems to have fundamentally shifted how global central banks view the security of holding U.S. dollar reserves. It's pushed them structurally towards gold for diversification, safety.
And this massive rally, obviously, it's reviving that classic gold debate we hear across financial circles.
Right.
On the advocate side, you've got someone like Ray Dalio, the ultimate Wall Street pragmatist. He sees parallels to the early 1970s high debt, the end of the gold standard, and he's advising investors allocate as much as 15% of their portfolios to gold. That's way above traditional advice. He's echoing J.P. Morgan's famous line, gold is money, everything else is credit.
Right, the gold is money argument. And then, of course, you have the eternal skeptic, Warren Buffett. His quote from 1998 is always trotted out, how gold gets dug out of the ground, melt it down, dig another hole, bury it again, and pay people to stand around guarding it.
Chuckles lightly.
Yeah. It has no utility, he said. Anyone watching from Mars would be scratching their head. But, clearly the average investor right now seems less focused on utility and much more on finding protection from the chaos being caused by us Earthlings running our global governments.
That perfectly captures the mixed signals, doesn't it?
Yeah.
Okay, so let's recap quickly. We've tracked the colossal capital pouring into AI deals, Anthropic's expansion, those massive xAI and NVIDIA OpenAI partnerships. We've grappled with the policy friction points, both in the U.S. and Europe shutdowns, the French fiscal crisis, escalating global tariffs, and we've watched investors simultaneously flee into gold as this hedge against all that global uncertainty, pushing it past $4,000 an ounce.
Right. Which leaves us, and you, the listener, with a pretty important question to mull over, I think. The massive valuation of these AI companies, it's entirely predicated on that promise of wonderfully profitable long-term returns, as NVIDIA's CEO put it. But if global policy instability and these resulting trade conflicts keep raising the cost of key inputs, whether that's steel for building data centers or sophisticated chips facing export bans, does this persistent geopolitical friction create structural, maybe even permanent, headwinds? Headwinds that the current high-flying valuations just aren't adequately pricing in. Basically, can the future really be wonderfully profitable if the present feels so structurally unstable?
A critical question, and one that definitely keeps us looking forward and watching that friction very closely. We'll see you all tomorrow morning with new headlines from major financial magazines.